In this video, I'm going to discuss how to deal with partial periods when we're dealing with depreciation. If you saw the video on depreciation methods, I explained a few depreciation approaches, and I also did an example of the depreciation amount for a whole 1 year interval. Here in this video, I'm going to talk about how to deal with partial periods. So specifically, I'll look at straight line depreciation, double declining bounds, and some of the year's digits, which is where partial periods may arise. This is based exactly on what the other video stated. This was the depreciation we computed for the whole year, assuming a half-year convention for this information. Okay, so let's look at what the information is. Assume that an asset with a historical cost, or think about it as a purchase price of $279,000, has a salvage value of $15,000 and a useful life of 10 years or 25,000 hours. Now notice that for the units of production, I don't have partial period issues really, because I only depreciate based on the amount of hours I use, independent of what days that represents. Whether it's a half a year or whatever, it doesn't matter. I'll just take whatever amount of hours. So for that reason, even though I have units of production as one of the examples here, we don't have partial period issues with that as well, okay? So the only ones I'm really going to address are these three right here: the straight line, double declining bounds, and the sum of the year's digits. So let's change the assumption here of a half-year convention. If you recall, if we use a half-year convention, it means that if I place the asset to use, if I put that asset to use before the half-year mark, then I depreciate it for the whole year. Otherwise, I depreciate half a year if it is put in place after half of the year. So in our case, for the half-year convention, using a calendar year, I told you that asset was placed to use on 1/16x1 for a half-year convention. So the halfway point would be June 30th. So because it's put to use before June 30th, we depreciate the whole 12 months from 1/1 until 12/31. And that's what we did in that previous example. So if you want to refer to that to see how we computed these numbers, go ahead and do that. Now, here's the new information. Assume instead that we have a half-month convention. So what this dictates is that instead of, here, let me write this a little better. Instead of assuming half a year, you're just assuming that each month is the one we analyze, not the whole year. So if I place this asset to use on January 16th, that's past the midway point of the month, meaning that since it is past the midway point, I do not depreciate for January. Instead, I start depreciating the month after. So in this case, when I ask you to compute depreciation, it's not going to be from January 1st. That's assuming a half-year convention. Excuse me here. All right. It's going to be under a half-month convention. I'll start February 1st. So overall, what we'll have is for the fiscal year X1, we're going to have depreciation of 11 months. So how I compute that is straightforward. I have the amount that I would normally depreciate for a whole year. So I would multiply that times the time adjustment factor of 11 over 12. Straightforward. And that gives me 24,200. So if I were to visualize my T account for accumulated depreciation, that would be posted as a 24,200 in X1. Then X2, just to kind of visualize this whole thing, X2 will be a full 26,400, right? So you'll see 26,400 for the next year, because the X2 will be 12 months. And you'll continue doing that until the end. And here's something where you have to be careful. So these would be the other years, X3 to X8. And then this is 26,400. The 10th year, you're going to have 26,400. But look here, you're going to depreciate this asset until the fiscal year the fiscal year X11. And you're not going to be depreciating the asset over 11 years. You're just going to depreciate it over 11 fiscal periods. Now, why do you need to go into the 11th fiscal period? Well, this X1 represents 11 months, right? And because of that, you're going to have to remember to account for that extra 1 month left over. So in other words, the last fiscal year will be X11, and it will be equal to 26,400 times, let me take that comma out, 26,400 times 1 over 12. And that gives you 2,200. Okay, so don't forget that. Even though this is a useful life of 10 years, let me make this a little smaller here. Even though this is a useful life of 10 years, since you have one partial period in X1, then you will need to go to that 11th fiscal year, which does not mean that you're depreciating the asset over 11 years. You're depreciating the asset over 10 useful years. Okay, this is 11 months and this is 1 month. So that's something to be careful about. And just for the sake of organization here, I've color-coded anything with straight line here with this light green so we can keep it organized. And anything with double declining bounds follows the light blue, and finally the yellow for some of the year's digits. All right, let's look at let's look at double declining bounds. Based on the original video where I introduced depreciation methods, we came up with 55,800. So here, I'm going to apply the partial period of 11 months out of 12, which gives me 51,150. I post that again to my accumulated depreciation account for X1. Again, remember this is 11 months, so it's going to go into 11 calendar years, right? And then X2, we need to compute it because this depreciation method always is based on the book value at the beginning of the period times the rate. So we came up with this double straight line rate being 20%. That was from the earlier video. So every period I'm going to apply 20%, 20%, 20%. That's always going to be 20%. But do remember that when you get to X11, maybe I should put here X10 and then X11. This will always be 20%, but then this last one is going to be 20% times 1 over 12. Same idea as before. Okay, so I'm just doing a little table here to help me, excuse me, organize and compute the depreciation amounts. The formula for declining bounds to compute depreciation is always going to be book value at the beginning of the period times the rate. Okay, so the rate we said was 20%. Let me just change this up a little bit here so it looks a little better. Okay, so this is how you compute depreciation under double declining bounds every time. Get the book value at the beginning of the period times the rate. So that's exactly what we did over here. When I did 20%, I did the book value at the beginning of X1. Technically, this is the book value at the end of the previous period, which becomes the beginning value of the next period, right? So it's 279 times 20% times 11 over 12, which gave me this amount. Now, for the second period, be careful. Now, this is your ending book value, which becomes your beginning book value for X2. So you're going to multiply, let me see if I did the formula there. There. You're going to multiply the book value at the end of the previous period times 20%, and that gives you 45,570. And you continue doing that. You continue doing that, so let me just copy it down. And you go all the way to 11 months, but I don't want to go there yet, okay? Because I want to show you something you got to be really careful about. Recall that both double declining bounds and some of the year's digits are referred to as accelerated depreciation methods, right? Based on the original video on depreciation methods. So with them, you're going to naturally depreciate very quickly. You might not even get to the 11th year before you will have fully depreciated. And this is where you have to be very careful. This column, I'm going to just put a square box on it, I guess. I don't have anything else I could do. But this this rectangular box here, the summation of all of these cannot be more than the depreciable amount that we determined initially. So recall that the depreciable amount is 264,279 minus 15. So you got to be really careful with these accelerated depreciation methods, because you might get to the 8th year, the 9th year or something, and the computation of 20% times the beginning book value might take you to a summation that's greater than that. In which case, at that point, you either ignore the computation and just plug it so that the summation of everything ends up being 264, or your depreciable amount, or some companies choose to then shift over to the straight line method. And it doesn't matter. Whatever you do needs to be systematic and rational, we said, right? But do be careful that you check that you don't go above 264 in this column right here. So you may not even need to do this calculation at the end, because you might have switched method, or you might have done a plug just to get to the 264 even before the 11th year. That's what happens with some accelerated depreciation methods. Okay, so that's for the double declining balance. Now let's look at some of the year's digits. For the sum of the year's digits, we came up with the depreciation for 12 months of 48,000. So if I apply a partial period of 11 months over 12, that gives me 44,000. Again, I'm visualizing the accumulated depreciation T account. Here's 44,000. And I also recognize that this is for 11 months. So I have an 11th calendar year that I need to address later on, maybe. And here's the table that I use to compute this information. And it's similar in nature to how we compute declining balance, but there are some subtle differences that are very important. Number one, we start out with the depreciable amount. So since we are starting out with the depreciable amount, and this should not say this should be historical cost minus salvage value, and it's always going to be 264. That was a mistake here, sorry. It's always going to be 264. You're not going to change that. And here's why. Under the sum of the year's digits, we are taking fractions every year. We're taking, the first year, we're taking 10 out of 55. Next year, we're taking 9 out of 55. And when I say year, I'm talking about a 12-month period, right? Okay, then we take 8 over 55. And if you continue adding those up, just mathematically, the last one will be 1 over 55. If you continue adding these fractions up, you're going to get 55 over 55, which is 100%, right? So after you depreciate this over the 10 years, or whatever amount of calendar periods it is, you're going to have depreciated 100% of this 264. So you start out with 264. You don't have to worry about this being greater than 264 like in declining balance. You don't have to worry about that, because your fractions will take care of that. Okay? Your fractions here at the end will sum up to 100% in the same way that I added up to 100% here. But here's where you have to be careful. Since each 12-month interval, and this is very critical, since each 12-month interval is a different percentage, this is one percentage, this is a smaller percentage, this is a smaller percentage than that, so it just continues to decrease percentage-wise, right? Since it is a different percentage each period, notice how I have 2 slots here for X2. And what that means is I have to compute this ratio of 10 over 55 over a whole 12-month period every time. So for fiscal year X2, it's going to be 10 divided by 55 times 1 over 12 plus, okay, I'm going to put a plus here, plus, okay, this formula is not going to work, but we'll do it in a minute, plus 9 over 55 times 11 over 12. This group right here, these two, is the total depreciation for X2. And I'm not going to do the math here, but you would multiply, I guess I could, you know, that's not a big deal. So let me go ahead and do this. This would be 264 times the fraction 1055 times 1 over 12, okay? Plus, but let's do one at a time. Oops, did I do something wrong here? Oh yeah, this is not needed here, sorry. Okay, so that's 4,000. And by the way, it makes sense that it's 4,000. Remember how the whole year depreciation at 10 over 55 was 48,000? Well, if we split 11 months of it and it's 44, the rest of it is 4,000. But now I also have to sum up, 264 times, wait, Excel doesn't like commas like that, times the new fraction 9 divided by 55. If I could find the right buttons here, times 11 over 12. Okay, so I did, for fiscal year X2, I did this part, and now I'm doing the second part. And the summation of these two is the depreciation for the whole 12-month interval. And that's this. So let me just sum it up. Let's sum these two up. And of course, it's too small, so just make it bigger. Now, I don't want to go crazy with a whole bunch of numbers, but basically what this means is that the depreciation for X2, let me find a little bracket here that can help us out. The total depreciation for this period is going to be 43,600. That we just kind of computed here on the side. All right, I'm going to move this out of the way here because it's getting too close and it'll just make it look disorganized. So again, fiscal year X1 made up of 11 months is 44,000. Fiscal year X2 made up of 12 months, okay, made up of 12 months, but with different rates is 43,600. Technically, you don't need this column right here. You know, I wanted to make it look as parallel as the other one, but you need this column for declining balance because this is changing and you need to refer to this changed amount every time you do the computation. Whereas some of the year's digits, you're always multiplying times 264 because you're going to multiply 100% over the 11 fiscal periods. You're going to multiply 100% of 264. Okay? Every single year, you're going to have to do this again. Here, this is going to be 9 over 55 times 1 over 12. And then 8 over 55 times 11 over 12. That's just how it's going to be every single time. Okay, so this would be 43,600 would be what I post to accumulated depreciation for fiscal year X2. So it is a little bit of an extra step here that you have to do. So don't get confused, all right? The key here is that once you apply a rate, that rate needs to be applied for 12 months. And you have to break it down like this because you have differing rates. Now notice how with declining balance, I didn't have to split it up like we do here. And the reason I don't have to split that up is because the rate always stays the same. It's 20%, 20%. So if I apply 20% to this book value for a whole 12 months, that's fine because the rate is the same. But with some of the year's digits, the rate changes every 12 months. So if I have a calculation between dates, between 12-month intervals, I have to do this every time. Okay, so a couple things we did here that just to recap, when you have partial periods, depending on whether it's due to a different half period convention. It could also just be because you put it to use at some other date. Okay, but it doesn't matter how it arises. You just simply do that partial period. Not a big deal, right? But make sure that you track, if this is an asset that has 10 years, make sure you depreciate over 10 years. If it's per month, you're going to depreciate over 120 months, right? 10 times 12, 120. So in here, I better see 120 months in total, because that would mean I depreciated for the full amount. The other thing you want to be careful about when dealing with this is make sure that when you do double declining balance, you start with the book value initially, right? And the book value initially here was book value, the definition of book value, just to be clear, is equal to historical cost minus accumulated depreciation. So at the beginning, when you first buy this asset, you have a historical cost of $279, but you haven't depreciated anything. So your accumulated depreciation would be zero. It would be $279 minus zero, hence $279. So when you start out with declining balance, make sure you start out with your book value at the beginning of the period every time and compute the percentage based on that. As you depreciate, the book value goes down. So this is the book value used for the next calculation, etc. That's something you got to watch out for. And then with sum of the year's digit, the big thing is if you're going to apply a rate, make sure you apply that rate for a whole 12-month interval, which means we get into these quirky little things. All right, this concludes the video on partial periods of depreciation.